This pipeline giant just sold off a multi-billion-dollar business unit, used the cash to pay down debt, and is still paying out a 7% yield, all while trading near its 52-week high. Let's break down Plains All-American Pipeline, ticker PAA on the NASDAQ. Plains units trade around $23.19, near their 52-week high of $25.03, giving the company a market cap near $16.4 billion and a distribution yield near 7%. As a master limited partnership, Plains pays out distributions rather than dividends and issues investors a Schedule K-1 tax form instead of a standard 1099. Second quarter 2026 adjusted EBITDA attributable to Plains came in at $738 million, up 10% year over year, with the core crude oil segment up 19% on higher pipeline volumes and the recent Cactus III acquisition. Diluted net income per common unit jumped to $2.51, though that figure was heavily boosted by roughly $3.5 billion in net proceeds from selling its Canadian NGL business, a deal that closed in May. That sale is central to the story here. Plains used the proceeds to pay down debt, pushing its leverage ratio down to 3.3 times, the low end of its target range, while simplifying the company toward a more pure-play focus on Permian Basin crude oil. On the growth side, Plains has been actively expanding its Permian footprint, including the roughly $2.9 billion EPIC crude pipeline acquisition, now rebranded Cactus III, and being expanded by another 75,000 barrels per day. Management raised full-year adjusted EBITDA guidance to a midpoint of $2.880 billion, with bumped-up growth spending to fund that expansion. The distribution itself has grown fast. Plains raised its quarterly payout 20% back in February of last year and has continued raising it since, now sitting at 41.75 cents per unit. Wall Street sentiment is mixed, but generally positive. Goldman Sachs upgraded the stock on the crude outlook, and Truist stayed bullish in July, though Zacks just downgraded it to hold this month. The average analyst price target sits at $24.47. Management has also pointed to recent Strait of Hormuz disruptions as a reminder of why reliable North American crude infrastructure matters, a geopolitical tailwind for domestic pipeline operators like Plains. So is this a simplified, delevered pipeline operator paying a strong yield with real growth ahead? Or a stock already pricing in the good news at a 52-week high? Not financial advice.